You must have heard that term goodwill many times on business shows or financial talks. But what is goodwill and how is it created? And why some companies have goodwill worth of billions of USD and others don't have goodwill at all? If you want to have answers to those questions, stay tuned. Goodwill is an intangible asset, not physical, that is associated with the purchase of one company by another. Goodwill is the portion of the purchase price that is higher than the sum of the net fair value of all assets acquired and the liabilities accepted in the purchase. That means goodwill equals the purchase price minus the net fair value of assets and liabilities. So it is the excess amount in the purchase price above the net fair value of assets and liabilities. Let's say that you are going to acquire or buy a company and that company happens to have assets of 2 million USD fair value and liabilities of 1 million USD fair value. If that company is very famous in the market, leading the competition and doing a great job, do you think the owners will sell it for 1 million USD, which is fair value of assets less fair value of liabilities? I don't think so. You are dreaming. A 10 years old kid will not accept that price. But where is the goodwill coming from? It is all due to the company's brand name, customers list, good customers relations, good employees relations, and overall market perception. Theoretically speaking, calculating goodwill is fairly straightforward, but in practice it is a bit complicated. To calculate goodwill in a simple formula, take the purchase price of a company and subtract the net fair market value of identifiable assets and liabilities. Let's say that you want to acquire a company and the owners asked for 10 million USD as a selling price. After you looked at their financial statements, you found that they have a net fair value of assets subtracting liabilities of 2 million USD. In that case, the goodwill equals 10 million less 2 million, that equals 8 million USD. The value of goodwill typically arises in an acquisition when the acquirer purchases a target company. It is the excess amount the acquiring company pays over the target's net assets at fair value. Sometimes the acquiring company pays less than the target's book value. In that case, we will have a negative goodwill, meaning that it purchased that company at a bargain because that target company is doing bad or bankrupt. Goodwill is recorded as an intangible asset on the acquiring or purchasing company's balance sheet under the long-term assets. That means goodwill can be accounted for and recorded on financials only if purchased or acquired. That means if you have your own company and you started that company from scratch and it is now very famous in the market, you wouldn't be able to account for that goodwill in your books as it is not purchased and it is internally generated. IFRS prohibits the accounting and recording of internally generated goodwill. Again, goodwill must be purchased, and that is to stop the manipulation of financial statements, as every company will say, I believe my own goodwill is worth that much, and that will overestimate assets and manipulate financials. Under generally accepted accounting principles and international financial reporting standards, companies are required to evaluate the value of goodwill on their financial statement at least once a year and record any impairments. Goodwill is considered as an intangible asset or non-current asset because it is not physical and it is not like buildings and equipment. Impairment of an asset occurs when the market value of that asset drops below historical cost. This can occur as a result of an adverse event such as deteriorating business, declining cash flows, increased competition, or economic downturn. Companies assess whether an impairment is needed by performing an impairment test on the intangible asset. The two commonly used methods for testing impairments are the income approach and the market approach. Well, we came to the end of that video. I'm Sam Hillside. See you soon.